Ready to invest your money on Wealthsimple, but worried you'll accidentally lose it all? You're not alone. Wealthsimple has made investing super easy, but that ease can also lead new investors to make some costly and very common mistakes. Mistakes that can quietly eat away at your returns and make you feel like investing just isn't for you. But the good news is, these pitfalls are easy to avoid once you know what to look for. So, let's talk about the top 3 Wealthsimple investing mistakes beginners make and exactly how to dodge them. Mistake number 1, panic selling during a market dip. Imagine you log in, and your portfolio is down 5%, maybe even 10%. Your gut screams sell everything before it gets worse. This is a huge, emotional mistake. Markets go up, and markets go down. That 10% dip isn't a loss until you actually sell. What's often happening is a temporary setback, and history shows the market almost always recovers. If you panic sell, you lock in your losses and you miss the inevitable rebound. The fix? Embrace a long-term mindset. When you see red, don't sell. Instead, see it as an opportunity to buy more at a discount, a practice known as dollar-cost averaging. Wealthsimple makes this easy with auto deposits, so you can just keep feeding your account on a schedule, regardless of what the market is doing that day. Mistake number 2, chasing hot stocks without diversifying. This is a classic trap, especially if you're using Wealthsimple Trade to pick individual stocks. You hear about a company that's doubled its value in a month, and you think, I need to get in on that. You pour a huge chunk of your money into 1 or 2 stocks. The problem here is a lack of diversification. If that single stock takes a sudden dive, your entire portfolio goes down with it. It's too much risk. The simple solution is to use broad, diversified funds. On Wealthsimple, this means focusing on low-cost exchange-traded funds, or ETFs, that hold hundreds or thousands of stocks. If one company fails, it barely moves the needle. If you're using the automated Wealthsimple Invest service, it already builds a diversified portfolio for you, which is why it's a great option for true beginners. Don't undo that benefit by loading up on speculative individual stocks. And finally, mistake number 3, not having an emergency fund first. Investing is for money you won't need for at least 5 years. A major mistake is putting your rent money, or your emergency savings, into the market. If an unexpected bill pops up, like a car repair or a medical expense, you'll be forced to sell your investments to cover it, potentially at a loss. The way to avoid this is simple. Before you invest a single dollar, build an emergency fund of 3 to 6 months of living expenses and keep it in a safe, liquid place like a high-interest savings account. Wealthsimple even has one of those. This cash buffer protects your investments from your life, allowing them to grow untouched over the long haul. Avoid panic selling, stay diversified, and secure your emergency fund first. Do those 3 things, and you'll be well on your way to building real wealth with confidence. With that said, thanks for watching, and until next time.